Hello everybody, it's Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. And after asking and you all telling me, I'm going to be doing the subscriber request series every Tuesday. Now I do ask you to be a little patient with me. I've got a lot of requests. There's only so many I can do. But I am going to do that every Tuesday. Now I'm going to produce a video on a subscriber request. So I'm going to look at stocks that you guys have told me that you're interested in looking at. Now today, I'm going to cover two oil and gas storage and transportation companies, Enterprise Product Partners and Enterprise Transfer. Now, I'm going to look at these companies solely on the basis of their operating cash flow, but in doing that, I'm also going to talk a little bit about just how difficult it is to analyze these kind of stocks. Now, the beauty of it is, though, these actually turn out to be pretty good investments. So I'm going to take a look at the long-term performance of Enterprise Products Partners here. But before I do, a couple of data items. Number one is the company is trading at a blended priced operating cash flow of about 7.95. We'll call it 8 times operating cash flow. Historically, it is traded at 11 times cash flow. I'm looking at operating cash flow here. Now, I do want you to notice how kind of bizarre this looks like, because they made a major acquisition back here, which shot their cash flows way up. But then to do that, they also ended up issuing a lot of shares and created a lot of dilution, which actually brought their operating cash flow back down. That dilution that is very common with these MLPs, and this one does, by the way, have a K1 associated with it. You do have to file a K1. It makes them very, very difficult to analyze, and by no means do I consider myself an expert in master limited partnerships in the oil and gas industry, but I'm going to talk about that a little bit more here and show you some people that theoretically do have some expertise. But this has a really excellent long-term dividend record, as you can see. So let's look at its performance going all the way back to December 29th, 2000. And the thing I want to show you is the company has a very high yield. You know, if you'd have bought it on that date, your first year, you'd have received 7.4%. And I do want you to notice that your income steadily increased. This is one of the real advantages. Over, the period of 2001 through yesterday's close, your $10,000 would have thrown off over 3 times your original investment in dividends alone. And that's really the strength of investing in these. Now, from a standpoint of capital appreciation or total return, the company also pretty much mirrored the S&P 500. It grew by 5.1%, or created an annualized rate of return of about 5.1% per annum. Now, I do want to point out that if you look at that from a standpoint of what related to the company's earnings growth rate, you can see that it's very consistent with the company's operating earnings growth rate. Low valuation at the beginning, and the current low valuation had, some impact on that. And again, normally we would see this at around 11 times operating cash flow. But I want to look at dilution here a moment, because I consider this very important. As they came through, you can see the company from 2001 up through the recession and into the recession of 2008 took their share count from 342 million shares in 01 up to 875 million shares in 08, and that was above 869 million shares in 07. Now, they also then made this major acquisition, which caused this huge spike in cash flow. But then what I want you to notice here is, then they issued a whole bunch of stock in 2010 and 2011, all the way up through 2019, they continued to issue shares. So they were diluting their shares from 1.7 billion shares to 2.1 billion shares. But then I do want you to notice in 2019, they got 2.2 billion and 2.2 billion. The company has been funding their business out of their cash flows for the last couple of years at least. So that's kind of a positive. But when you're dealing with these stocks and investing in these stocks, what makes it difficult to look at historical data like this is how much the share count has changed, how dilutive these stocks have been. Now, having said that, an advantage of these stocks, let's look at it from a standpoint of gross revenues here. So I'm going to take a look at gross revenues. Their revenues, grew like a weed up through the Great Recession. And of course, this was that acquisition. And since that time, and even on the fact that this is gross revenues now, not revenues per share, they were able to generate some very strong revenues, although more recently their revenues for the last couple of years have been falling a little bit. If I shorten this time frame quite a bit, You can see that their revenues fell from 36 billion down to 27 billion in 2002. So that's something that you would, really want to think about. Morningstar rates Enterprise Product Partners 4 stars, and they talk quite a bit about the quality of this company's management team. And I think that, that's something that you really want to look at. They also believe that the company has a wide moat based on its efficient scale moat source, they call it. And what they talk about here is also the depth and quality of the company's management. So I'm not going to get into all that. I'm going to let you guys do that on your own. But the reality of it is this company, they consider their management to be really great stewards of capital. But they give the company 4 stars, and they give it a fair value calculation of $25.50. So currently the stock is trading at 21. If I kind of point it up here to the normal PE, that's 29. If I use the forecasting graph and use the normal multiple, and by the way, we're looking at operating cash flows now, that gets me to about a 29 if they go to a 10.7, which is their normal price to cash flow for the last 5 years. We'll call it 11 times cash flow. So somewhere in this 25 to 29 range is, I would classify fair value as well based on the numbers I see on FastGraph, based on the consensus estimates. So that's kind of in line with what Morningstar is saying. So the company is, very interesting from a standpoint of it's been a great long-term performer. It has a very consistent dividend payer. Their dividend is very well covered by cash flow. The stock is dilutive, as I pointed out. I think that's something that, you all have to be, really aware of when you're looking at a stock like this, and, recognize the fact that, the companies, these midstream partnerships, they will raise capital quite a bit to do things. They made an acquisition. They ended up issuing a bunch of shares in 2011. And I want to focus on that just a little bit. In 2011, if you will, their stock was actually pretty pricey. So I don't really like the idea that they did that. I like the fact that they were issuing shares when their stock was fully valued. I don't like to see a company issuing shares when their stock is undervalued. Right now, I consider the company very inexpensive. It offers an 8.36% dividend yield. It's very, very well covered. It's one of the highest credit ratings of any company in the midstream partnership, and it's got this excellent track record of paying the dividend. So, if you don't care about the K1 and you're looking for an income vehicle that might kind of keep up with inflation, this might be the ticket. But I do want to point out that the long-term growth rate for this company is expected to be relatively low. But if I put that at an 11 times cash flow, 10 to 11 times cash flow, there's double-digit rates of return to be made on this stock going over, the next 3 to 5 years at least. And management talked quite a bit about that in their most recent earnings call, about the fact that, fossil fuel energy, green energy is where the current administration is kind of leading. But the reality of it is fossil energy is not going away, and I happen to agree with that. So the next one I want to cover is Energy Transfer. Now, this is another K1 limited partnership. Again, you see this really kind of crazy cash flows. And cash flow growth has been extremely high over the long run here. But if I cut this down to an 8-year graph, I do want you to notice that operating cash flow has actually been dropping by about 1%. The company did cut their dividend rather precipitously. They went from $1.22 to $1.07 in 2020, and they're estimated to only pay 61 cents this year. However, having said that, it offers an 8.17% yield at the current valuation, at the current dividend rate. But there is a possibility that, that yield will be dropping over the next year or two. When you look at this company from a long-term performance point of view, as we did with Energy Transfer, you get a slightly different story. You also get a very high dividend rate. 10,000 would have paid off almost 21,000 in dividends. You would have made a slight capital appreciation, about 2% compared to a market. Now, this is a different time frame than I showed you with Enterprise Partners. This company hasn't been public as long. This is going from February of 2006. So it kind of underperformed on capital appreciation. But what's interesting is when you add in the dividend income, it actually mirrored the market. It came out with actually a slight, although very slight advantage, 35,500 versus 34,458. So, because of the dividend and the yield, it outperformed. But this company's dividend yield has been under pressure here more recently. So, once again, you're looking at a company that's very difficult to analyze. The company issued a bunch of shares in 2019 and then issued more in 2020. They just did make a large acquisition that Morningstar talks about. They said they can't resist the M&A temptation. And that might be a positive here from the standpoint that it does give them, the ability to grow. But the company has gone out and made a major acquisition here. Again, I'm not real familiar with this stock. You could, if you're a Morningstar subscriber, you can read about it here. But, the company has done well. Morningstar gives them a fair value of 18. If I went through that same process I did with Energy Products Partner and looked at the normal multiple. But before I do that, let's make sure we look at the normal price to cash flow of this stock has been in the 6.5 to 7. It's been a lot lower. But if I point to it, that gives me that 18 fair value number, or 17.65 based on what FastGraphs is showing. So, that's consistent with what Morningstar says. Now, the last 5 years, the normal price to cash flow has only been 4. So if I put that back up to that 5 or 6 number that Morningstar showed earlier, I come up closer to that 15 to 18 fair value range that Morningstar is giving it. But again, I find this one a little more difficult to own. I don't like the fact that they cut their dividend. And I do want to make another point. If I look at this company from a performance perspective in more recent time, going back to 2013, it actually has generated a very negative rate of return. Even including dividends, it would have lost money. So this one has been a challenging company. It's theoretically turning itself around. It made a major acquisition. That's going to allow it to eke out a little bit of growth. But again, these are dividend plays. My money would be on Enterprise Products. Energy Transfer, I think, is a little bit too iffy for me. But it's BBB minus rated with 73% debt. It's got a high credit rating for an oil and gas storage and transportation company. Anyway, this is your subscriber request. I'm not I don't consider myself an expert on these master limited partnerships. They're very difficult to analyze because of the dilution that I talked about, and so on and so forth. So it's something to be considering as a shareholder. You're constantly facing the idea that these companies might be going out raising capital. Enterprise Product Partners has not issued any additional shares for the last couple of years. That's kind of a plus. Both of these companies are generating free cash flow, I might point out. Free cash flow performance hasn't been great on Energy Products. Let me show you free cash flow here. But they are expected to be covering their dividend with free cash flow going forward for the next couple of years. That they just first started. When I look at Energy Transfer and look at it from a standpoint of free cash flow, their free cash flow has grown substantially. There's a lot of talk about these companies paying off debt. There's a risk of these companies going to a C Corp. Common wisdom right now says that both of these companies are going to stay in the MLP structure, which is good or bad depending on your point of view, but they are expected to generate very strong free cash flow covering their dividend in the next couple of years. So there's something positive to say about both of them. But again, they're difficult companies to analyze. I don't think they're for everybody. They do come with a K1. These are things that you would want to, focus on. Energy Transfer has a better long-term debt to capital, ratio, if you will, and a slightly better credit rating. But they're both companies that do offer a very high current yield here. And going forward, they might be interesting if you're looking for income. Anyway, this has been Chuck Carnevale saying thanks for watching on the Subscriber Request Tuesday series here on these two master limited partnerships, Enterprise Product Partners and Energy Transfer. If you like this video, go ahead and give me a like. Share it with people if you think they'd be interested in seeing videos like this. And of course, if you're not a subscriber, please subscribe to my channel to get more videos like this. In the future, I'll be doing the Subscriber Request series on Tuesday. I appreciate everyone's feedback. Tuesday was one of the days that came out. Maybe it's because I asked on a Tuesday last week. But anyway, bottom line, I like that day because I can come in on Monday, get myself gathered up for the long weekend, or the weekend, if you will. And then, that gets me in a position to, do some work, because a lot of these companies I don't own or don't follow. I am long Enterprise Product Partners, by the way, for the obvious reasons. Anyway, this has been Chuck Carnevale saying thanks for watching. And by the way, I want to make one last point. I don't use earnings to evaluate these because of that dilution I showed you earlier. It really is all about cash flow and whether cash flow is covering the dividend, in my opinion, with these, with these partnerships. Thanks for watching.